when you guys know as well as I do that lawsuits are basically just assumed over your careers. If you don't know that, please assume that will happen. I hate to say that, but it will happen over
only
your
a matter
careers.
of time.
Yeah. Those banana peels, they come out of nowhere. And
this is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grenzig. With me, as always, is John Cohen. How we doing?
We are good. We got an awesome guest, I believe. We're going to have some fun. I know we got a potential time issue, so we will kick it right off, but I'm good, and we are excited for our guest today.
Yes, no back and forth between us. We're going to jump right into it. So that being said, Mark, thank you so much for joining us.
Oh, guys, it's an honor. Been loving your show, and I can't wait to get into some fun content together today.
Yeah, absolutely. So kick us off, just a little bit about you, your background, what you do.
Sure. So my name is Mark Willis. I'm a certified financial planner. I'm not your average financial planner. So I've worked with folks along the country lines, all 50 states, and even into Canada, and work with folks who want to build real wealth outside of Wall Street in ways that are safe and predictable, and help folks become their own banker, become their own source of financing. I believe that banking is the problem, but self-banking can be the solution to a great majority of the problems I see in most people's financial lives.
Awesome. Why do you say banking is the problem? I'm curious.
Well, banking, I guess in essence just is, there's a great book out there David Graeber wrote called Debt, the First 5,000 Years. And that title alone is the best part of the book. I mean, he has a great history of like debt and banking, but banking exists just because, it's as old as farming. When you kind of go back into the history of it all. And so banking is going to exist after the coronavirus is gone, a footnote in history. Banking will continue. Banks are really a noun, but banking is the verb. And I would say that banking is something that for many generations was done in-house, but we have outsourced the function of banking to large and small banks. Doesn't matter the size. The problem is the person behind the desk. If you're not the person behind the banking desk in your life, you will not be in control of your financial future, just plain and simple. If banks control the environment where your money lives, they're going to win. If you are the banker and you control the environment where your money lives, you will win. I don't care if you have a great real estate portfolio or one that just, is a C average or just barely passing. If you are your own source of financing, you control the environment. Your money is going to thrive. It's going to survive. It's going to multiply.
Kind of out of left field, but I think a large majority of the country, people maybe that don't ever listen to podcasts like this or, listen to someone like you, Mark. Why is it that the country has such a one set type of lifestyle that doesn't really fit into the mold that we often talk about and you're kind of talking about? I don't know if you have any thoughts on why that is or not.
It's a great question, man. I don't know the answer precisely, but I'll give you an idea. So there's something out there called the Overton Window. Are you guys familiar with the Overton Window?
I'm not.
So it's a political idea, and it's the reason why politicians never tell you what they actually believe. Okay, so we're recording this, amidst the presidential debates, and you're not going to hear either candidate's real belief about X, Y, or Z issue. And the reason is the Overton Window. So what is it? Well, there's really kind of 6 stages, and the stages are unthinkable, heresy, and then finally you get into like, radical, acceptable, and then finally policy. So we go from unthinkable to policy in all of our spheres of life. You could think about that in politics. You could think about that with your health. You could think about that in your marriage. You could think about that with your finances. So when I got my first day job, or when all of us listening got that first real job, what did we get handed? We got handed a binder with our health insurance and this thing called a 401k, most of us. How long have we had 401ks in this country? Most people would say, well, it's policy. It's unthinkable to have anything other than a 401k. You're not a real adult until you get that 401k. Guys, do you realize that the 401k is not even old enough to retire yet? It just had its 40th birthday this year.
That's
okay.
Crazy.
So if the 401k tried to take money out of itself, it would get penalized. That's how young the 401k is, right? So I think it's amazing to me that we are all in this grand retirement experiment, and that the way you're supposed to do it is you get your job, you put your money in that 401k, you don't look at the market when it crashes. We treat the stock market like an abusive relationship. Don't look at it when it's hurting you. It's your fault that you're in this position. It'll always come back. These are things that we say about abusive relationships. And yet, that's how we talk about the average way of thinking. So I don't want to be average. Average is 6 credit cards, a mortgage that I can't keep up with, buying stuff that I don't even like to impress people I don't even want to be around with money I don't even have. That is the average way of doing finances in this country. Let's not be average. Let's be awesome. Listen to podcasts like you guys and do something that totally revolutionizes not just your life, but the lives of your children, your grandchildren, and 4 generations out.
Yeah, it's crazy because I have a bunch of thoughts, about the stuff you just said. But the one that just struck me at the end was I was having a conversation with my mom probably like 2 or 3 months ago, and talking about something similar like this. And honestly, I forget what the whole conversation was, but she said something that stuck with me, and it's something I just never realized. She's like, I don't think you understand how much better of a grasp you have on the world and finances and the economy than most people. And it's true. Like, I don't feel like I know that much. Like, when you were talking about banking, all I could think about was I watched this documentary on JP Morgan because I thought it was crazy interesting, and how he started up during, like the post-Revolutionary War, and how he was in London and doing all this crazy stuff. And I forget where I watched it, so I can't tell people where it was.
Come on.
And I know, I think it was, I want to say it was, I think it might have actually been on YouTube, actually. I think it was like a series from like this YouTube channel. But anyway, like those are the things that like I find interesting and I want to know about. And you just said 6 credit cards, and I was like, holy crap, like that's a lot. Like, I think I have 3 and I hate it. Like, I just got a business credit card, and I'm like, I almost didn't get it. The only reason I did it because I knew doing my taxes would be easier. That's the only reason. But so many people live that way. The biggest problem that I always see when you were talking that relates to this is when people go to buy a home, they go find out how much they can afford to borrow, and they take the maximum amount. And I hate that. I hate that with a burning passion, because it's so opposite, and you just hamstring yourself, because there's the narrative of your home as an asset, and you can argue one way or the other, but you only have that one thing. Then you can't do anything else. I just find that crazy. Yeah,
totally agree. I think the concept of home as an asset is a very interesting and long-standing tradition. Back to Overton's Window, it's considered policy. It's considered the standard way we do things to prepare ourselves for retirement. What do? You pay on a giant mega McMansion, and you hope and pray that the real estate market will always go up. Well, I started working in the financial space in 2008 and 9. So you guys, I guess you could call me a post-recession planner. And we were going through the less great recession at that time. I'll call it the less great recession, because I don't know what we're about to go into right now after coronavirus. But, I realized that real wealth is not found in my home. I cannot get the money out of my drywall unless I have a generous banker willing to give it to me. I'll say that again. All of our money that we pay on our mortgages earn us no interest. There's no tax deduction now for that. We have no liquidity. If we need an emergency cash access, it's all tied up in the drywall, and we can only get it out when we have the ear of a generous banker. Now, think about it this way. When are banks least likely to give us cash? In good times or bad?
When you need it.
Yeah. And when are you most likely going to need it? During bad times, right?
Exactly.
And when are we least likely able to sell our house at a reasonable price? Same time, during a crisis, correct? So, we have this liability.
Actually, not to cut you off, but right now we're in a crisis and the market, because right now I'm dying to sell my house because it's never going to be worth more than it is now.
You're so right. Yeah. I mean, there's an old quote, a banker is a fellow who will lend you his umbrella when the sun shines, but wants it back as soon as it starts to rain. And that's what banks do. I mean, I'm not against banking. I just think we have the wrong person behind the desk. You should be the banker for your major purchases. I'm talking about everything from your next car. Why not borrow from yourself, pay yourself back on a schedule that you control, pay yourself interest, right? Why not be a greedy banker when you're your own source of financing? Why not do this with your real estate deals? Heck, why not do this with your kids' college or your own college? This is what my wife and I did. Slowly but surely, we had been fed the Dave Ramsey, oatmeal for years. And at some point, we just woke up and realized, do we really just want to be debt-free? Is it so exciting to us to scream, I'm debt-free on his radio show, when all that means is I'm back at the starting line of my life? To be debt-free merely means I owe nothing and own nothing. What I wanted was something to be better than debt-free. That's something I can scream on a radio show or at the top of a mountain. So we found a way, my wife and I, to pay off. We had $120,000 of student loan debt when we graduated college. We found a way to pay all that off in a way that helped us become better than debt-free. In fact, we were able to become our own source of financing and literally pay ourselves back rather than pay some banker or Sally Mae for the privilege of being in debt to her. Guys, it felt like an extra mortgage payment. It felt like I married two women in college. I married my wife and I married Sally Mae. Well, that's not, what we wanted, but we found a way to claw that money back and actually get wealthy while we paid off our debts. And that's partly what we work on with our clients. As a CFP, we look at all the angles of someone's financial life. We follow the CFP certified financial planning process. We're proud to follow that process. I think it's a good thing to put people in the right path, to look at their taxes, their estate planning, their investments, their insurance. But I'd say the biggest and most fundamental thing that you can do is to ask yourself the question, what do I want my money to do for me? And realizing the fact that where you keep your money will make it act different. I'll say that again. It's so obvious, but I never thought about this very hard. I didn't spend 2 minutes thinking about it before we were in six figures of student loan debt. We had our 401k for some reason. We were following all the standard American advice. Where did we want our money to be? What do you want your money to do for you? Because where you put your money makes it have different ideas, characteristics, attributes. So that's actually a really good thought exercise. And if folks get nothing else out of this episode, just ask yourself, what kind of characteristics do you want your money to have? For me, it was, and I'll hush after this, but I'll give you just 3 or 4. We had a list of like 24, but we wanted predictable growth. We wanted some sort of predictable growth on our cash. We wanted access to the money at any time with no one being able to take it away from me. So accessibility, predictable growth. We also wanted it to be tax-free. I personally think that taxes are going up over my lifetime. So I want it to be accessible all throughout my lifetime without any taxes due. 401k does not meet any of those 3 characteristics. When I kind of share that idea of, hey, if you guys could wave your own magic wand, Josh, for Chris, for you, for John, for you, what kind of characteristics would you want your money to have if you could just wave a magic wand and let your money do whatever you wanted? What kind of things, guys, would you want it to do for you?
Yeah. So it's interesting because I was going to ask you, and it's going to basically answer your question. I've fought against, putting money into an IRA or 401k because I don't get it. I get it, but I don't get it because you can't touch it for years without paying penalty. And I just know stuff happens to people, and not having the ability to access that money, it's not really your money then, unless you're now going to pay an even larger penalty than you would have in the first place.
Yep.
And I keep having this conversation with people, and I feel like I'm beating my head against a wall or I'm wrong. And it's really interesting it sounds like you kind of feel the same way. If that, like you said, if that's something that's important to you, So I guess to answer your question, the accessibility of it to me has always been very important, which I think is why I'm somewhat against a house as well, because I was viewed of, yeah, I could probably buy a $300,000-$400,000 house right now and get a loan for 20%, 25%, or 80, 75%. But I'm like, I'm going to be tying up, in excess of six figures. Why do I want to do that? So for me, that's always been the biggest thing, is just having the ability to change my mind or make a decision or do something with it.
So I think that I'm on similar pages, right? I think accessibility to cash is key, especially where we are today, right? We don't know if we're going up, down, left, right, or sideways. Not having the availability of cash when you need it is a shitty thing. So that's a huge thing. Obviously, everyone wants their money to make money. Everyone wants their money to make a lot of money. I'm on the page of, give me predictability and stability and growth, and I'm good with that. But I also agree, right? I don't have an IRA. I don't have a 401k. I never had a job where it was even offered. But it's always been, entrepreneurial. I've always done my own thing. And I've battled with it. Like, should I have it? Should I not have it? But I agree. I'm in. Chris, we've even spoken about that. It's like, hey, listen, I have the ability right now that it's mine, right? I can do what I want with it when I want to do it. So I think we're all in the same boat. I also argue the house, although I have one, and I'm trying to get rid of it. Not get rid of it. That's not the right word, right? Because
I'll take it if you really want to give it to me.
Be careful. Your wife's going to come bursting through the door.
John, if you're really wanting to get rid of it, man, I'll take it from you.
Yeah, no, I think she's put the baby in bed so I could speak freely right now. So, I think those are all things that are important. I mean, and that's what I was going to say is, well, you've hooked me, right? So what is it, right? Where are we going? Right. What do you got? Because I think that most people, it's like that contrarian view. And I actually downloaded that debt book because I hate banks, and I think I'm on the record saying that they basically dictate what we do, and I don't like being dictated anything for the most part. So I actually got that book because I think I'm always interested in that stuff. But so what is it, right? What is that piece, or is that like the hey, we'll do a round two on it? But no, what is that answers those questions for the most part?
Yeah, it's going to sound crazy. I did a deep dive when doing my CFP training. Looked at 400 places I could park my cash. I'll give a few others. I wanted flexibility. I wanted some sort of tax-free access to the money. I didn't want governments telling me that I could only put in $6,000 a year like you can only do with an IRA. I wanted there to be some sort of creditor and bankruptcy protection, as well as privacy as well. So these were just sort of a number of things that I wanted my money to do for me. As a business owner, I needed all those things. As a real estate investor, I needed all of those things. I mean, you guys know as well as I do that lawsuits are basically just assumed over your careers. If you don't know that, please assume that will happen. I hate to say that, but it will happen.
It's only a matter of time.
Yeah. Those banana peels, they come out of nowhere and slip on them. So the thing that caught my attention the most is I was doing all of my due diligence for my own needs, but also for clients. After seeing people lose half their life savings in traditional retirement accounts, and basically concluding that, yes, it's fine to invest and speculate in the stock market, but it should only be with money I can afford to lose. But what I found, among all things, was this strange, very old-fashioned whole life insurance contract that met all of those characteristics that I just mentioned to you guys. So whole life insurance was not what I expected when I was doing my own due diligence for where to keep my cash. Mm-hmm. But a modernized form of whole life does a few things really well. I'll give you just really quickly 4. It grows on a guaranteed, predictable schedule every single year. Outside of the stock market, it beats my savings accounts. It beats my money market accounts. It beats my bond portfolio. And it's liquid and accessible. So I'm getting a decent, predictable, middle single-digit rate of return. And it's predictable. I know what the outcome is going to be every single year. I've got a number of these policies now, and they are still beating or exceed or matching exactly what we thought that would be happening at this point back when we started some of these back in 2011, 2012. Did I know in 2011 and 12 that there was going to be a bull market or a corona crash or a rebound? No. Did I know who was going to be president in 2020? No, of course not. But the policies grow on a predictable schedule. So that's the first piece. The second piece is that it is accessible without income tax due all of my lifetime. So it is a tax-free source of money anytime I want. I can be 59 and a half years old or 30 years old or 70 years old. There is no tax due when I access that cash. Under current law, both principal and gains can be accessed totally income tax-free, which is super cool. The third piece is it is life insurance. So we're looking at a modernized form of whole life insurance where you cut down the commissions and you accelerate how much access you have to liquid cash. So I'll zoom out really quick. There are two types of life insurance. There's the kind you rent, which is called term insurance. And there's the kind you own, which is called cash value insurance, or whole life insurance is one of those. If you have term insurance, a landlord, the insurance company, will raise the rent on you as you get older. And you have no equity, cash, in that policy. On the other hand, whole life insurance is one example of cash value. It grows in equity every year, helping you keep up with inflation, beat inflation. But the cost contributions stay level. So you're not, kind of like a mortgage, you're not increasing the rent on a whole life policy. So it's a forced savings plan. It's a way to pack away my profits every year. But unlike Dave Ramsey's hated whole life, you're cutting those commissions, the insurance expenses down by about 70%. So in year one, in month one, you've got massive cash value ready to borrow and use like a bank. So that brings me to my fourth and final thing. Then I'm going to hush, let you guys chat. The fourth thing is you become your own source of financing when you have a policy like this. It is a line of credit to yourself. If it's a bank on yourself designed whole life policy, and this is the only kind that does this. I've seen, oh heck, there's probably 1,100 life insurance companies in the United States. Maybe a couple dozen of them do what we want their policy contracts to do for us. But the biggest piece to this whole puzzle on the real estate side, on the personal side, is I can borrow against my life insurance cash value, and the policy will continue to grow even on the capital I borrowed, which sounds crazy just to say that. So I'll say it one more time. If I have $100,000 in cash value, which is pretty common, you can build that up, without too much trouble in these policies. You borrow out 30,000. So I've got 100,000 available. I borrow out 30,000 to buy a car or invest in real estate. My policy that year will still give me the same guaranteed growth and dividends on the entire $100,000 as if I had not touched a dime of the money. Now, to me, that is the key in the hole. That is the ace up your sleeve, because we have uninterrupted compounding growth on the cash value, right? Guarantees on the growth of the cash. And even when I liquidate the cash, even when I borrow against it, it continues to grow. There's nothing I can do to stop it. So Charlie Munger calls that uninterrupted compound growth. And that is the most important part of one's portfolio, not to the exclusion of everything else. Still invest in real estate. Still call John and Chris and give them all your money to invest in real estate deals. But using the whole life policy as your parking space, as the source of money for the purchase, for the investment, for rehabbing your kitchen, for sending your kid to college, is in my opinion, the best place for us to have a source of money to become our own source of financing, to fire your banker and to become your own source of financing. Okay, soapbox, I'm going to put it over here now and I'll hush for a while.
So I'm curious because my understanding of, and I could be totally wrong, I've not really looked into it, but the insurance policy stuff is basically similar to a bank where you give them money, then they go out and they do other things with it to, borrow money at X percent that they're guaranteeing you every year. And then they're going to go lend it out or do other things with it to generate a spread, and they keep the spread and you do that. I'm assuming it's the same concept, correct?
So when you give money, when you give money to a bank, what do they do with that money?
They go out and lend it to other things.
Yeah. So if I have $1,000 and I put it in my bank account, of that 1,000, how much is the bank required to keep on their books? Well, it's about
10,000, right? That's like 10%. It's not even that much.
Yeah. About $100 in good times. So 10% of my money is actually in a vault somewhere, and the other 900, it's loaned out to the guy behind me in line. So that is a powerful arbitrage right there.
Mhm.
You know, think about what banks are doing there. They just, how much of their own skin in the game do they have with that deal?
None.
Zero. Yeah, none. How much are they paying me as an interest rate to keep my money at their bank? Well,
Zero.
zero
Today,
point
yeah.
penny. Yeah. How much are they loaning out my money to the guy behind me? What's the
lot.
interest rate to that guy? Yeah, a lot more than zero. Yeah. So we call that infinite returns because it's not their money, right? And by the way, in 2020, they passed a law this year where the reserve requirements, John, are now 0%.
I was going to say like 5, but so yeah, there you go. So they don't even have to have anything in the bank.
This year. Yeah. I don't know what's going to happen next year, but that to me is not a safe place to keep my cash. Why? FDIC, everyone says is a great safe place. How much money does FDIC have? Less than 1% of all deposits are on reserve somewhere over at FDIC. So if more than 1% of banks fail, we're up a creek. You know, we're back to taxpayer bailouts or something worse.
Mhm.
So to me, you know, you have to kind of think about where the money is going. So yes, the insurance company has to keep more than 100% of my deposits on reserve to be considered life insurance in this country. And those are audited regularly by third parties. And what the insurance company does above my reserve requirement, so they're literally 10 times as safe as a bank in good times. But what they do above that deposit requirement, Chris, is they put that money to work, mostly bonds, real estate, you know, massive real estate deals, commercial deals, bond deals for the fixed income. And if it's a mutual life insurance company, not a publicly traded one, but a mutual company, then I participate in the profit of that company. I'm in essence, as a policy holder, I'm in essence an owner of that insurance company.
Mm.
You know, relative to a public company where shareholders are going to be the owners and they're going to get the dividends, you receive the dividends if the company is profitable, as we are basically, and in essence, the owners of the company. Nobody else is stockholder, shareholder. Did that get to your question?
Kind of. So if they have to keep in excess of over 100% of your deposits, why do they even take them?
Give me a bit more to your question. Why do they take
the
them?
bank? How are they making money on your money if they can't go re-lend it out? They're basically, if you give me $1,000 and I have to keep 1,100 in the bank for you, I've now come out of pocket to take your money, and I can only go lend out. If I match your 1,000, I can only go lend out 900. Why wouldn't I just keep my 100 and go lend out 1,000 and tell you to go F off?
Yeah, that's a really great question, Chris. So, you know, the best thing I'll say is they're not looking at this as a one overnight scheme. They're looking at it as a lifetime of income payments. And remember, they are us. They are us when it comes to mutual life insurance. There's no they when you are the owner of this company. So yes, they have to keep more than my deposits on reserve. But remember, they have a liability to my family, which is way more than my deposits. If I put $1,000 at a bank and I die, my family gets what? They get $1,000.
Mm-hmm.
If I put $1,000 in a whole life policy, depending on my age and my health, I'm going to leave my family, I don't know, 10, 15, 30 grand off that 1,000 just by being the nature of whole life insurance.
Mm-hmm.
Now their job, actuaries at these insurance companies, their job is make sure to only bring people into our company, insure people who are healthy. You know, so in that sense, they know that they're not going to need to give me all of my deposit back, and they can go put that money to work in the bond markets or real estate markets and get yield. Where does that yield go? It goes to pay death claims. It goes to pay, operation expenses at the insurance company, and then it pays out dividends on top of that. Mm-hmm. So I hope that answered the question.
Kind of. I think I need to do a deep dive and just understand the business model. I could probably question you for an hour and a half. But let me ask another question, because with anything there is risk or there is cons. So what are some of those things of this option? Yeah.
So don't use this as every last penny. Don't mm-hmm. put all your eggs in. Now, the insurance companies do diversify their general account, like I've been talking about quite a bit this episode. So we are spread among a number of assets, but you still need to think about this as a cash equivalent in your portfolio. So not to the exclusion of real estate investing. Actually, it augments real estate investing. but you'll be bored to tears with the returns if all you're looking at is the rate of return of the whole life policy. I've seen it do 3%. I've seen it do 6.5%, 7%. It's somewhere in that ballpark for most people. Mm-hmm. The rate of return to me is less important than the arbitrage that I get. So when I borrow against the policy, I'm still getting growth on the capital that I borrow. So it's not a great fit for folks that are expecting this to be an investment, because it's not. The other thing I'd say is, really it takes some time. There's some insurance expense. So if I put $1,000 in, back to one of your other questions, Chris, if I put $1,000 in these policies in the first year, I might have $700 available day one within mm-hmm. 30 days, something like that. So there's a purchasing price delta there that some folks just can't get over. Mm-hmm. And I really just try to emphasize, this is not a savings account. It's not a get rich overnight scheme. Mm-hmm. The longer you keep these policies in force, the more efficient they become. So back to that example, if it's year 5 or 10 or 20, you're going to be getting double, triple, and further afield, you might even get 5 times your contribution in a given year. Mm-hmm. As I look at my daughter's policy, I put a policy on myself and my wife, my daughter. She's 4. By the time she's in her 60s, she's getting 10 times the contribution per year that she puts into that policy. Mm-hmm. And it's all liquid, with no market risk. So it's just a matter of long range thinking. I'd say that's one of the cons. If you're wanting get rich overnight stuff, there's other places, legitimate places, you can get great returns, some not so legitimate. But there's some great places, but properly conceived of and solid expectations. It's a great tool in the portfolio.
Mm-hmm. One thing I remember seeing is like there are credit ratings for the different insurance companies. My understanding of what you're saying now and talking about is basically you are investing or giving money to that company, and another risk is that company goes out of business. Does that then mean that your policy and your money is gone? Is there any of that FDIC type thing? Like, is that another risk that's associated with it?
Yeah, there is no FDIC on life insurance. That to me doesn't mean a lot. Right. Back to my previous comment about FDIC. But there is some guarantee associations. There's some protections on a state by state level that protects you if the insurance company goes belly up. Quick story. In 2008, there were 450 banks that went bankrupt. Not bank branches, whole stinking banks that went belly up. Mm-hmm. There was one life insurance company that went bankrupt in 2008, just to kind of show you how solid these companies are relative to banks. But even so, that's one company with real people. So what happened to the cash in those policies at Lincoln Memorial, which went bankrupt in 2008? I did some due diligence on this, wanted to look into it. The State Insurance Commissioner of Texas, where that company had its headquarters, stepped in on behalf of the policyholders at Lincoln Memorial, managed the company through the bankruptcy, and then gave the contracts to another company, Banner Life, in that same state, that took over the guarantees, the cash accumulation, the death benefit proceeds for all the policyholders. So while it's not a fail-safe, everything involves risk this side of heaven, right? Life insurance companies generally have a specific, well-managed, as you said, third party to watch over their books, auditing them regularly. But even if they do go through bankruptcy, a state insurance commissioner usually swoops in and then hands off your contract to another company where your guarantees just keep flowing. So does that solve the problem? No, but it's certainly safer than, a lot of other places I could be parking my cash. Gotcha. Especially in tough times.
Yeah. All right. I think that's interesting. We are coming close to the end, so I do want to wrap it up. For people, outside, we obviously touched on the insurance company side of things a lot. What are some other things or some really great resources or, I guess, other things that people should be doing to either learn more about it or to be more financially disciplined or to, review different options? You said yourself, you looked at, I think, like 400 different places to park your money. That's obviously a lot of work. And I would bet most people aren't going to go look up 400 places, but how can people start working towards those goals of understanding what's right for them, reviewing different options, alternative options and exploring those things?
Mm-hmm. You know, that is a good question. If you really want to do everything, go get that CFP and learn it all. But, you know, barring that journey, that marathon, starting with that question, making a list of all the things, characteristics that you can imagine. Back to Overton's window. What's unimaginable? What could we create, soup to nuts? If you could wave that magic wand, take 30 minutes, take 10 minutes and just say, here's the characteristics. Write it on a sheet of paper and say, if I could just have it all, what would I want my money to do for me? Tax-free all the time, you know, great returns, access to the cash, legacies to my future kiddos and grandkiddos. I mean, just start writing those things down. Maybe my answers would be different than all of you. You know, it's just a question of what do you want your money to do for you? That is the most important. I hate to say it with superlatives, but I can't think of a better question to ask that can get you on the right path toward financial sanity, because we're living in insane times. But there are strategies and tactics that have been through pandemics before, life insurance being one of those industries. They've been through pandemics before. 1918, the companies I love to work with clients, when we have Zoom calls with folks and have phone calls with folks, we're looking at companies that have been around since the Civil War or just start of World War I. Within a century, you know, they've been doing this thing and providing these predictable growth patterns for folks. So starting with those questions, what do I want my money to do for me, before you put the labels on? I think that would be maybe a best first step, simple step. Certainly, shameless plug. Happy to have you guys check out our podcast, Not Your Average Financial Podcast, and learn more about some of these strategies. But that'd be a place I'd start is just look within and figure out what you want.
Are there any other good options that people, because I know you said it's, you know, what you talked about is obviously not a, you know, one place to do everything. Is there other things people should really be considering to supplement other options?
Yeah. So really having a parking space for your cash is just that. This whole life idea is a great parking space. But when it comes time to make smart decisions, or, you know, let's say we're covering an emergency, grab from the whole life policy, pay off that emergency or pay off the debt. But when it comes time to making smart investment decisions, man, there's a ton of places you can put your cash. You guys know a number of places in the real estate space. You specialize and work in those areas. I think that real estate is an amazing place. I mean, go back as far back as the pyramids, just for one example, as a great place and a great way to build real wealth. You know, you could look at anything that provides those similar advantages. You know, you create a portfolio based on what your goals are, what your objectives are. I could list a bunch off if you want. I mean, there's dynastic trusts, there's municipal bonds, there's annuities, there's real estate, there's REITs, there's mutual funds, but I don't care what the clubs are. You know, I really don't. Whole life insurance, throw that out. What do you want your money to do for you? You know, I would rather Jordan Spieth's golf swing more than his clubs. Well, the clubs are erroneous, right? I could pick up a stick. If I'm Jordan Spieth or Tiger Woods, I can hit the ball with a stick in the woods, you know? But if I've got only his clubs and I don't have the swing, I'm going to be in the woods, you know, all day long. So, you know, start with the swing, figure out what you want your money to do for you. And that'll help you with the swing. Does that metaphor make sense?
Yeah. That's perfect. I think that analogy will resonate with someone that doesn't play golf, or because I say, dude, you got to start from the end, right? You got to work backwards. If you don't have the vision of what you want and working it backwards, it's not going to work. So yes, you know, give me the tool or how to use the tool, and then I'll take the tool and use it.
There you go. There's a great quote. Gary Keller says, what's the one thing you can do such that by doing it, everything else becomes easier or unnecessary? So that presumes you know where you want to go and what's going to make it easier. But once you know those things, then you can start to say, what's the one thing? What is the small hinge that swings the big door? And to me, I've decided, and this is an opinion, that banking is the small hinge that swings the big door. I can solve for my kids' college. I can solve for income. I can pay off all my debts. I can operate my whole financial life as the banker to myself. I don't care what my mutual funds do. I have some. I have index funds. I have real estate. I don't care as much about the returns or what those things are doing today or who's sneezing on who on Wall Street, because I've got the banking function solved. And that feels good. That solves a lot of other problems. It makes everything else easier or unnecessary. So I'm off my soapbox again. Sorry about that.
No problem. I think that's a great place to wrap it up. Mark, thank you so much for coming on. If people want to get in touch with you, follow along, check you out, where can they do all that?
Guys, love the conversation. Such smart questions. You guys are awesome. Keep up the great work. Check us out at Not Your Average Financial Podcast. If you go there, there's a button that says request a meeting. Happy to chat with you for 15 minutes, go a little deeper on this, think a little different with your money, your economy, your future. There's a lot that has changed in this year, in this world, but a lot of things haven't changed. And we're honored to serve people. So check us out at notyouravagefinancialpodcast.com.
Yeah, awesome. All right, perfect. Thank you for coming on, and thank you guys so much for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you would do so. And if you are, please send it to someone that would get a tremendous amount of value from it. Mark, once again, thank you so much for coming on.
My pleasure, guys. Have a great day.